Hey everyone, in this video I'm going to take a deep dive into Tesla's third quarter earnings results. I'm also going to update my recommendation of Tesla stock. Coming into these earnings results, I did not have Tesla stock rated as a buy. I had Tesla stock rated as a hold. Now, I'm somewhere in between those extreme Tesla bulls who think that Tesla stock is going to be by far the most valuable company in the world. And then there's others who think Tesla stock is extremely overvalued. I'm nowhere in those extremes. I'm somewhere in the middle where I think Tesla is the best electric vehicle car company. But I also think that Tesla stock is expensive at the same time. So there's a kind of a push and pull there. So you're going to want to tune in to see my perspective on Tesla's earnings as I see them, as I perceive them. And then I'm also going to update my recommendation of Tesla stock. So let's jump right into these results and see what they could mean for Tesla stock investors.
I want to thank the Motley Fool for sponsoring this video. Visit fool.com/Parkev for the 10 best stocks to buy now.
Starting with the first slide here, which I've highlighted. The first thing is our cost of goods sold per vehicle decreased to $37,500 in the third quarter. Now, that's a big move downward for Tesla, and that's going to be their competitive advantage, is being able to lower the cost of production, and therefore they're going to be able to sell their cars at lower prices and still generate sufficient profits. That's the name of the game here. If they can continue to decrease the cost of production, they can generate profitability and still implement all of those price decreases that they want to implement to increase the number of units out on the road. So this was a positive development for Tesla stock investors. The next thing I have highlighted here is that they want to maintain positive free cash flow while investing in the company. Now, you can see this as a positive and a negative from depending on the perspective you're looking at it from. You can see it as a positive that Tesla's going to keep their cash flow positive. But at the same time, Tesla's cash flow was way, way positive before this quarter, before they started cutting prices and before competition really entered. And so you can look at it as, okay, yeah, cash flow is going to stay positive. But now what you're telling me seems like cash flow is going to barely be positive going forward. We're not going to get those multi-billion-dollar quarterly positive cash flows like we were used to getting out of Tesla in 2021 and 2022. Finally, what I highlighted last is that they have more than doubled the size of their AI training compute. I look at this as positive because this is one of the things that I want Tesla to invest in, is the driverless car technology, autonomous driving. And so that requires a lot of computing power to process all the data that's coming in to be able to have that driverless car technology. This is necessary. They need to do it. Doubling the size, you can argue it's too fast, it's not fast enough. I wouldn't argue either way. I think Tesla has done a good job managing expenses and investment. They've done a good job increasing profitability over the last 5, 6, 7, 8, 9 years. So I think their decision to increase spending on AI training might be prudent actually, because they're realizing that investing in increasing production capacity might not be the smart thing to do right now, because there's so much competition out there from other EV companies increasing production. They've had to cut prices significantly. So maybe increasing production right now is not the smartest thing to do. Maybe it's smarter to develop this in-house technology to generate these longer term profits 5, 6, 7 years down the road. So the next thing I want to look at is two big items here, starting with total automotive revenues, which only increased by 5%, which I see as troubling. Third quarter automotive revenue at 19.6 billion was only up slightly from 18.692 billion from the third quarter of 2022. However, Tesla did have planned maintenance time, planned upgrade time at their factories, and so that can be explained partly by those planned upgrades. However, were those planned upgrades timed so that they happened in this third quarter when Tesla is facing strong competition? That can also be part of the reason why they decided to reduce production capacity in the third quarter. Here is an even more troubling trend for Tesla stock investors, and that is total gross profit, which came in at 4.178 billion. That was down from 5.382 billion, which was a 22% decrease in overall gross profit. If you look at gross profit margin, that was even worse, coming in at 17.9%, down from 25.1%, and the total gross profit margin has fallen for 4 quarters straight at least, and I wouldn't be surprised if the gross profit margin keeps falling further as Tesla needs to continue cutting prices to sell vehicles, again, as a result of not only increasing competition, but Elon Musk talked a lot about this in the conference call, and that is the slowing macroeconomic environment. People's incomes are not growing as fast as they were in 2022, 2021, and 2020. Interest rates are much higher than they were last year and the year before and the year before that. So that's making it harder for any car maker to sell cars, let alone Tesla. So it's not just Tesla that's experiencing difficulties because of these macroeconomic conditions. Most car manufacturers and sellers will feel this crunch as well. And then income from operations also falling significantly, down 52% to 1.76 billion, down from 3.688 billion, and operating profit margin, just like gross profit margin, is falling big time from 17.2% to 7.6%, a 964 basis point decrease, and that too has fallen for 4 consecutive quarters. And I wouldn't be surprised if this continues falling as well, because not only is Tesla experiencing having to lower prices to sell cars because of all the factors that it's facing, but it's also increasing investments in technology that are not going to start paying dividends way down the line, right? They're investing in the robotics technology, they're investing in the driverless car technology, both of which is not going to start paying off for at least a few more years. And so in the near term, the profit margins and profitability will be impacted. And if, of course, if you've got falling gross profit and falling operating profit, your earnings per share is going to decrease. And that was down a whopping 44% to 53 cents, down from 95 cents per share. And on its own, it's not that big of a deal. Many companies experience decreasing earnings per share numbers. But what makes it more troubling for Tesla is that the stock was already so expensive. The stock was valued at such a premium valuation because of the significant progress it was making in growing sales, growing profits, growing profitability. And if you're going to turn around, if you're going to hit an inflection point when it's reversing, that creates bigger trouble for the stock price and the stock valuation, because can investors continue placing a premium valuation on a company that's no longer delivering those kinds of premium results, right? The premium valuation should be reserved for companies delivering premium results. And from what we're seeing from Tesla over the last couple of quarters is not premium results. We're experiencing usual typical car company type cyclical results. When the economy does well, a car company does well, right? Because more jobs, people want more cars, interest rates are usually lower, and economic activity is better, so you're buying more cars. And the flip side is also true. When the economy is slowing down, fewer cars get sold, and the car company does worse. So you're seeing typical car company behavior out of Tesla, but it's not valued like a typical car company. It's valued more expensively than even a technology company. So for that reason, it's even more amplified when you see these kinds of results out of Tesla. And then free cash flow falling 74% from 3.3 billion down to 848 million. And then I mentioned earlier those figures of Tesla saying we want to be positive free cash flow, right? Yeah, but if we look back, in 2022, you did 3.3 billion in cash flow. In the fourth quarter 2022, 1.4 billion in cash flow. So now you're just saying you're going to be positive, like what, 100 million, 200 million, something in that. That's a big drawdown from those billions in free cash flow investors were used to. And that partly the reason why they were paying such an expensive price for your stock is because you were delivering these excellent results. So going on to production numbers, Tesla produced 430,000 vehicles in the third quarter. Like I mentioned, they had planned downtime, but still, even considering that, production was up 18% from the third quarter of 2022, and deliveries were also up 27% in the third quarter of 2022. So production numbers, they're on pace. And Elon Musk also highlighted that they're continuing on their pace to hit their target of 1.8 million vehicles produced in 2023. I mentioned earlier in a video that I don't think that's at risk. The only question mark is how much are they going to need to lower prices to hit that 1.8 million target? How much are they going to need to lower prices? That's the key. That's the question. It doesn't seem like it's a question whether or not they're going to hit 1.8 million. That seems like a foregone conclusion. It's only a matter of what are they going to need to sell those cars at to get to that 1.8 million. And you can see vehicle inventory is still as high as it's ever been at 16 days of vehicle inventory supply. And that I wouldn't say is too troubling. Um, if it starts rising further, we can start saying that it might be a risk. But usually, this is not uh, an alarming signal. When you've got a growth company, inventory needs to grow along with expanding sales. That's okay, that's fine. That's not something to get concerned about unless it starts growing exponentially and inventory starts piling up. Then you can start to say this might be a risk. But for now, I don't think the inventory is a risk for Tesla. And here's some good news. Supercharger stations increased by 31% to 5.59 million, and supercharger connectors also increased by 31%. To me, if I'm an investor in Tesla stock, which I'm not, I would want Tesla to increase their supercharger stations and supercharger connectors. From what I've researched throughout charging industry, Tesla's charging stations are the superior ones. Not only are they faster, but they're working more often, right? You don't go to a Tesla supercharger station that has 12 connectors and 8 of them are out of service. You don't see that as often with Tesla as you do with some of the other providers, right? The other providers are not as good as maintaining their supercharger stations as Tesla is. I think this is a competitive advantage for Tesla that it should double down on and really emphasize, because this also makes it more attractive for car buyers to buy a Tesla when they know there's increasing availability of charging stations. They can feel better about buying a Tesla because they have access to more charging stations. In my opinion, this is the number one reason people hesitate from switching from traditional cars to electric vehicles is the massive inconvenience of charging. You could fill up your tank of gas for in less than 2 minutes or less than 3 minutes, let's say, but charging your electric vehicle to full charge, even with a supercharger, is going to take multiples times longer than you can fill up your gas tank. And so if they can bridge that gap by increasing the number of stations and increasing the speed at which, by doing more superchargers instead of regular chargers, you can at least reduce that inconvenience for electric vehicle buyers and thereby increase the willingness to purchase. All right, so the exciting news about the Cybertruck, which remains on track for initial deliveries this year. I know investors were hoping this would happen sooner, but this has been delayed, and it's not new with Tesla. They typically make ambitious forecasts and tell you something's going to happen maybe in the third quarter of 2019, and it doesn't actually happen until like the third quarter of 2021. So they are a bit slower than their forecasts would predict. But still, if as long as they produce this Cybertruck and it becomes popular and they're able to sell over 100,000 units, which it looks like that's what they're planning, then that should be okay for investors. But you've got to temper your expectations, right? And Elon Musk did you know offer investors some drawdown in terms of the optimism for the Cybertruck, which he said is probably not going to be profitable in 2024. And they've only got capacity to produce about 125,000 units of the Cybertruck. And so if you look at 2024, Tesla's production is likely going to be over 2 million units in 2024. So the Cybertruck is going to be, I don't know, maybe 5% at best of its total output in 2024. So it's not something that's going to be a near term significant driver of revenue or profitability. In fact, it's probably going to be negative profitability in 2024. We just, as an investor, you just want to see this coming out on schedule. You want to see fewer hiccups and you want to see this thing start rolling out so that it can start generating sales and profits sooner rather than later. There is competition here for the electric vehicle truck space. Ford has the F-150 Lightning. GM is launching its Sierra, and and then you've got Rivian with the Rivian pickup truck. So there is competition in this space. It's not going to be the Cybertruck alone here. So investors will still want to see this come out and see the progress on this front. Moving on to artificial intelligence, driverless technology, the thing I would be most excited about if I was a Tesla stock investor. They have commissioned one of the world's largest supercomputers to accelerate the pace of AI development, with compute capacity more than doubling compared to the second quarter. The large installed base of vehicles continues to generate anonymized video and other data used to develop the FSD capability. And you can see the chart here of the cumulative miles driven with FSD growing exponentially. This is why it's critical for Tesla to sell more units, right? This is why I think Tesla doesn't mind lowering prices to get more units out on the road. That can collect more data, and then later on down the line, if it ever achieves driverless car technology, it can sell that software upgrade to all of those cars that are out on the road, generating thousands more in revenue and profit from all of those cars on the road. This is the big catalyst that could drive Tesla's stock price. This is why one of the reasons why I think Tesla stock deserves at least a little bit of a premium valuation, because it has this potential. Because it has this potential, you got to give it some probability that it will succeed in this endeavor because it's invested so much into it. Maybe it won't succeed at the time it said it will, but there is a likelihood that it will succeed in this measure. There's a non-zero chance, and so you have to assign a probability of success, and the reward, even on a small probability of success, is massive. And so that creates this catalyst for Tesla's stock price, given this chance that it has of accomplishing this feat. And this is something I'm always watching, looking out for Tesla stock. And then I talked about earlier in the video, the average cost per vehicle was $37,500, and they continue to work to reduce the cost further. Excellent. I love to see this. This is one of the main competitive advantages for Tesla, is that it's further along in progress in the electric vehicle production. And so it's generated more success in bringing costs down, achieving economies in scale. And you can see the cost of goods per vehicle heading down for 1, 2, 3 quarters straight. And that's great news for Tesla stock investors. Another reason why I've been saying that Tesla stock does deserve a premium valuation over other car companies, because it does such a better job in achieving economies in scale. Pay-per-use supercharging remains a profitable business for the company even as we scale capital expenditures. Our team is focused on materially expanding supercharging capacity and further improving capacity management in anticipation of other companies joining our network. Excellent. I love to see this. If I was a Tesla stock investor, I want to see them expand their supercharging network. That's also a nice recurring revenue stream for Tesla down the road. It can generate every month people, or every few weeks, people need to charge their vehicles. Paying Tesla to charge their vehicles is an excellent revenue stream for the company to generate, as well as it encourages people to buy Tesla cars because they see more of these supercharging stations. So it's a virtuous cycle that feeds on itself as Tesla invests and expands in its supercharging network. And finally, I'll end the video with this. I've been talking about this outlook from Tesla for volume. For 2023, they expect to remain ahead of the long-term 50% compound annual growth target with 1.8 million vehicles for the year. Now, I've been saying and I've been warning Tesla stock investors that Tesla might remove this outlook of 50% compound annual growth for the long term because it's finding it harder to do that. It's needing to cut prices a lot more. It's needing to invest more in increasing capacity, and it's becoming more expensive as competition has come into play. The cost of goods sold and the securing of materials is not as easy as it used to be before there was competition. During the conference call, Elon Musk gave a hint to this and said, look, we can't grow 50% forever, right? So that could be one step towards removing this statement entirely from Tesla's outlook. And I've warned that if Tesla does remove this statement from the outlook, that could drive the stock price lower 10 to 20% almost instantaneously as soon as investors see this removed from their shareholder letter, because a lot of investors are, the reason why they're paying that premium valuation for Tesla stock is because of this much better than industry level growth and delivering economies of scale at growth. So this is a big thing to pay attention to, and it could be why if you were following Tesla yesterday after hours, when the shareholder letter came out, the stock was flat. It was up like 1%. And then when they held their conference call and Elon Musk started talking about all of the factors impacting sales, he sounded pessimistic, and he gave that statement where he said, look, we can't grow 50% forever. That's when the stock price fell. And you can notice today, the stock is down 9%, right? Most of this 9% drawdown came when Elon Musk started talking during the conference call, giving that pessimistic outlook. And so it wasn't from the shareholder letter that the stock price fell. It was more so due to the conference call and the pessimistic tone that Elon Musk took in that conference call, highlighting all of the factors that's impacting sales, the falling macroeconomic outlook, higher interest rates making it harder for people to buy cars, and so on and so on. Okay, so now let me update my recommendation for Tesla stock. Coming into this report, I had Tesla stock not rated as a buy, and I'm not going to recommend it as a buy after this report. If anything, I would move it lower on my rating scale. So I have a scale, I might say if a stock is a sell, hold, or a buy, but I also have a scale like, is it closer to a buy or is it closer to a sell? Right? Coming into this report, I would say Tesla stock was a hold, but closer to a buy. After this report, I would say Tesla stock is still a hold, but it moved closer to a sell. It moved closer to a sell. So I'm slightly downgrading my outlook on Tesla stock following these earnings results. A slightly moved downward. I would still say the stock is a hold. I would still say the stock has excellent long-term prospects. It's one of the better EV companies in the world, and worldwide governments are supporting the growth of electronic vehicles. It's also spending billions of dollars in developing the driverless car technology. If it does achieve driverless car technology, that's going to boost revenue and profitability significantly, and on and on. So it's got excellent prospects, but it's already expensive. So some of those excellent prospects are already priced into the stock. And so you're kind of having to speculate, well, how much of that is already priced into the stock? It's already so much more expensive than any other car company. And then it's also more expensive than tech companies too. Tesla stock is more expensive than Apple or Microsoft. And so you're asking yourself, okay, we know it has excellent prospects, but how much of it is already priced into the stock? So for that reason, I'm keeping Tesla stock rated as a hold. But before I let you go, if you've gained any value from this video, please subscribe to the channel. It'll really help support the channel and it'll help me make more videos just like this one. Thank you so much for watching.